There is a very specific kind of silence that settles over the market right after the final bell on a Friday. It's not the relaxed silence you imagine, traders closing laptops, ties loosened, a week wrapped cleanly. No, this is the silence where the screens stop moving but the consequences don't. It's the silence where risk teams don't go home, where the lights in a few glass towers stay on, not because anyone loves their job, but because something on a spreadsheet has started to look like a leak you can T-patch with tape. And this weekend, the silence feels heavier because silver didn't do what it was supposed to do. All week long, the market had a script. You could feel it in the way the price moved, in the way momentum kept getting tested at the same levels, in the way the headlines and social media chatter tried to frame silver as overextended and ready to cool off. And then Friday came, the day that, for decades, has been famous for the same emotional pattern. A strong week, a rally that gets people excited, and then a sharp sell program into the close that steals the optimism and ruins everyone on S weekend. Silver investors even have a name for it, Friday fatigue. You've probably lived it. You watch it climb Monday through Thursday, you start believing again, and then Friday arrives and wham, something hits the futures book like a hammer. Price drops, the candle closes ugly, and you spend the weekend second-guessing yourself. But this Friday was different. The market tried to push silver down, tried to pin it, tried to shake it, tried to make the close look weak. And instead of collapsing, it held. Not only held, it accelerated into the close. When the dust settled, the screen froze on a number that changes the psychology of everyone watching. 67 to 14. That's not a normal close. That's not a we'll see next week close. That as a close that forces people on the wrong side of the trade to stare at their positions for 48 hours while markets are shut, while news keeps moving, while narratives build, while Asia approaches its opening, while the world has time to think. For retail holders, it feels like a victory. For the professionals who are structurally short or managing clients who are short, it can feel like a weekend in a pressure cooker. Now, let's be careful here. When people hear banks trapped or shorts underwater, they jump straight to a movie plot. Villains, secret meetings, control rooms, a single lever pulled to smash the price. Real markets are messier than that. They're not one person. They're incentives, risk limits, leverage, liquidity, margin rules, and human emotion under stress. But here's what is real and measurable. When a market closes near the highs on Friday after failing to break down, the probability of a volatile open increases. Not guaranteed, nothing is guaranteed, but the setup changes. And that setup is exactly what we're going to unpack across this series. Because the story here isn't just silver went up. The story is what that close does to everyone who built their week around the assumption that the rally would fade. It changes the math of risk. It changes the behavior of dealers. It changes the way premiums behave. It changes what people demand, paper exposure versus physical metal. And most importantly, it changes the emotional posture of the market. There are moments where investors fear a crash. And then there are moments where the bigger fear becomes something else, fear of not owning enough. You can see that fear in the tape when buyers don't wait. In a normal market, buyers try to be clever. They try to get a better price, they place bids lower, they wait for pullbacks, they assume liquidity will appear. But when fear flips, when the fear is not, I'm going to lose, but I'm going to miss it, buyers become aggressive. They cross the spread, they lift offers, they accept worse entries because position matters more than precision. That kind of buying into the close is a change of character. It doesn't prove the future, but it tells you something about the present. Demand is not acting patient. So let's talk about the Friday script and why breaking it matters. For a long time, silver has been the kind of market where rallies invite skepticism. It's volatile, it's emotional, and it has a long history of sharp pullbacks that punish late buyers. That history creates a reflex. When silver rallies hard, the crowd expects the rug. That's why Friday weakness has been so powerful. It reinforces the reflex. It teaches people to doubt strength, to sell too early, to treat rallies as traps. But when a market refuses to follow the script, it can do something even more dangerous for short sellers. It can rewrite expectations. And expectations are not just feelings, they're positioning. Many participants in silver don't just have an opinion, they have leverage. They have exposure across futures, options, swaps, structured products, hedges against inventory, hedges against industrial procurement, hedges against mining output, hedges against customer demand. In that ecosystem, the moment a key level breaks and holds, risk models start blinking. Not because the world is ending, but because leverage amplifies small moves into large consequences. A $3 move in silver is not just $3. On millions of ounces, it's an event. On leveraged exposure, it's a margin conversation. And margin conversations are not theoretical. They happen in a very simple language. How much collateral do you have and how much do you need by Monday morning? That's why weekends matter, because while markets pause, collateral requirements do not disappear. They just wait. And waiting is where anxiety grows, because no one knows what the open will look like. No one knows what narrative will dominate the weekend. No one knows whether Sunday night trading will gap up, drift down, or whip both directions. So institutions do what institutions always do under uncertainty. They run stress tests. They model scenarios. They ask ugly questions. What happens if silver opens at $68.50? What happens if it prints $70 in thin liquidity? What happens if volatility spikes and options dealers have to hedge? What happens if a fund that was short has to buy to close, forcing the price higher, forcing another fund to buy, pushing the market into a feedback loop? Again, none of this is destiny. But it is a setup that can form quickly when leverage is crowded to one side and the market refuses to give relief. Now, while the paper market wrestles with positioning, something else happens in parallel that most people only notice after it's already underway. The physical market reacts differently. Physical dealers don't operate like futures traders. A futures trader can hit a button, close a position, and be flat in seconds. A dealer has inventory. A dealer has replacement risk. A dealer sells you a product today that they may have to restock tomorrow at a higher price. In calm markets, that's manageable. In violent markets, that can be fatal. Imagine you're a dealer who quoted customers when silver was lower. You took orders. You promised delivery. You expected to restock at roughly the same levels. But then the market jumps and premiums expand at the same time. Now you are staring at a brutal reality. Your cost to replace what you sold has moved against you. That's when dealers freeze. Not because a conspiracy told them to, but because the business becomes a liability when pricing is unstable. Some dealers will go sold out. Others will raise premiums sharply. Some will throw up maintenance mode. That behavior is not proof of a global shortage by itself. It's proof of a market where replacement cost uncertainty makes sellers defensive. And defensive sellers create their own kind of vacuum. When the public sees price rising, demand tends to increase because attention increases. Meanwhile, supply at the retail level can tighten because sellers don't want to quote aggressively into volatility. The result is the same picture again and again. Buyers pushing forward, sellers stepping back. And when buyers push forward into a market with less willingness to sell, price can move faster than people expect. That's how squeezes begin, not always as an engineered event, but as a mechanical imbalance. So here is the core question for this entire series. Is this move simply a hot rally that will cool off? Or is it the early stage of a repricing event driven by deeper pressures, industrial demand, tight inventories, and a market structure where paper claims and physical metal behave differently under stress? We're not going to answer that with slogans. We're going to answer it with mechanisms. We're going to look at what a weekend margin call actually is, how it creates forced buying, and why forced buying can be violent. We're going to look at the physical chain, how premiums, inventory, and delivery timelines behave when replacement risk spikes. We're going to look at the institutional side, allocated versus unallocated exposure, and why wealthy holders sometimes demand clarity at the worst possible moment for a fractional system. And we're going to end with a Monday playbook. Not financial advice, not hype, but a checklist of signals that tell you what's real and what's noise. But before we go deeper, I want to set the tone. If you are here for easy predictions, it will open at $72 by Tuesday. Banks will lose control. It's guaranteed to hit 100. That is not what this channel does. This market is dangerous. It can reward patience and punish leverage. It can rally so fast it feels like a miracle, and then drop $3 in an hour just to test whether you have conviction or whether you're a tourist. The goal is not to panic buy or panic sell. The goal is to understand what kind of week you're stepping into when silver closes a Friday at the highs and the world has 2 full days to marinate in the implications. Because that's what makes this weekend special. The screen is frozen, but the machine isn't. The stories are still being written. Risk is still being measured. Dealers are still requoting. Funds are still calculating collateral. In next part, we're going to walk into the risk room and break down the mechanics of the weekend margin call. What it is, how it works for institutions, why it can force buying at the worst time, and why Monday morning can turn into a stampede when too many players need the same exit at the same time. When people hear the words margin call, they imagine something instant and dramatic. A flashing screen, a computer taking over, a position liquidated in seconds. That image is mostly true for retail traders, for institutions, for hedge funds, for large commodity players moving millions of ounces. The reality is slower, heavier, and far more dangerous. And it almost always gets worse over the weekend. To understand why this Friday close matters, you have to understand how institutional risk actually works. Big money does not trade the way you do. They don't click buy or sell with cash sitting idle. They operate inside a layered system of leverage, credit lines, prime brokers, and internal risk limits. Every position is connected to a spreadsheet somewhere, a living document that measures exposure, volatility, and worst-case scenarios. Most of the time, those spreadsheets are boring. Friday night, after silver closed at the highs, they were not boring at all. Inside every major bank and prime brokerage is a risk department whose job is brutally simple: make sure the firm survives. They don't care about narratives. They don't care if a trader was right in the long run. They care about one thing: whether losses exceed collateral. When that line is crossed, ideology dies and mechanics take over. Here is the key detail most people miss. Margin is not checked continuously for institutions the way it is for retail traders. It is settled daily. At the end of the trading day, the exchange calculates who won and who lost. The losers owe money. That money is called variation margin. Under normal conditions, it's routine. Funds wire a few million, positions continue, nobody panics. But Friday was not normal. Silver didn't just rise, it rose into the close after attempts to push it lower failed. That matters because many short positions were built on the assumption of a late week fade. When that fade didn't come, losses didn't just increase, they locked in. The bell rang, the books closed, and suddenly, losses that traders hoped to manage intraday became official. Now imagine you are running a leveraged fund short silver. You sold futures at $64 or $65, confident the market would cool. You didn't expect to be down more than $1 or $2, but the screen freezes at $67.14. On paper, you're down over $3 an ounce. On millions of ounces, that's tens or hundreds of millions of dollars. The exchange marks your position. The prime broker updates your account. And now the question becomes very uncomfortable. Do you have enough cash to cover this? This is where the weekend becomes dangerous. Banks are closed. Markets are closed. You cannot easily raise cash. You cannot sell other positions instantly. You cannot hedge the trade. You are stuck with your exposure while the world keeps spinning. News keeps flowing. Headlines keep building. Asian markets loom. And every potential catalyst, geopolitical tension, industrial demand headlines, currency moves, adds psychological pressure. Because if the market opens higher, your problem grows. This is when the phone calls start. On Saturday morning, the risk desk calls the fund. The conversation is not dramatic. It's cold and procedural. You are down X. Your available collateral is Y. You have exceeded your credit threshold. We need Z wired by Monday morning. The fund manager might argue. They might say the move is temporary. They might insist silver will pull back. None of that matters. Risk management does not trade opinions. It enforces limits. If the fund cannot commit the cash, if they can guarantee that the money will be there by the deadline, the next sentence is even colder. If the funds are not received by the cutoff, we will reduce your exposure. That's the polite way of saying we will liquidate you. Here's the critical point. Forced liquidation does not wait for the right price. It does not care about value. It does not care about charts. It has one instruction: close the risk. And if the position is short, closing it means buying. Buying at market. Buying into thin liquidity. Buying regardless of how ugly the price looks. This is how weekend margin stress turns into Monday morning gaps. The danger compounds because margin calls don't happen in isolation. One fund gets the call. If they are forced to buy, the price moves higher. That higher price pushes the next fund closer to its own margin limit. Another call goes out. Another forced buyer enters the market. This is not conspiracy. It's a mechanical chain reaction. And that's why markets sometimes open on Monday like they've been shot out of a cannon. Now, it's important to be honest here. Not every rally produces this effect. Many rallies stall, many breakouts fail. Risk desks are conservative, but they are not stupid. They don't liquidate everything at the first sign of trouble. However, when leverage is high and the move is fast, the margin for error collapses. And Friday's close narrowed that margin significantly. But the futures market is only half the story. While risk managers stare at spreadsheets, a very different kind of calculation is happening in the physical market. Physical dealers live in a world of inventory, not contracts. Their risk is not mark to market, it's replacement cost. When silver is calm, dealers can quote prices confidently. They know they can restock at similar levels. When silver becomes volatile, that certainty evaporates. Picture a dealer who sold physical silver on Friday morning. They took cash, they committed delivery. They expected to restock next week at roughly the same price. Then the market closes at 14, and premiums begin to move. Suddenly, replacing that inventory might cost significantly more. If the dealer sells aggressively into that environment and the price jumps again before they restock, the business eats the loss. Enough of those losses, and the business is done. So what do rational dealers do when volatility spikes and the market closes at the highs? They pull back, they slow sales, they raise premiums. Some pause quoting altogether, not because silver is gone, but because selling into uncertainty is dangerous. This behavior creates a visible effect to the public. Sold out signs, higher prices, longer delivery times. Demand appears to surge at the same moment supply seems to vanish. This is where narratives explode. Some people scream shortage, others scream manipulation. The truth is more mundane and more powerful. Risk aversion. Sellers step back, buyers step forward. Price becomes the only tool left to restore balance. Now, layer in one more institutional mechanism that almost never gets discussed in public: unallocated metal. Large banks and vaulting institutions hold metal on behalf of wealthy clients in two basic forms: allocated and unallocated. Allocated means specific bars, serial numbers, your name on them. Unallocated means a claim on a pool of metal. Most of the time, unallocated works fine. It's efficient, it's liquid, it's cheap, but it relies on confidence. When prices are stable, nobody questions the pool. When prices spike and rumors of tight supply circulate, confidence wobbles. And when confidence wobbles, some clients ask an uncomfortable question: can you allocate my metal? That request forces the institution to act. If they have the metal sitting idle, allocation is simple. If they don't, if some of that metal has been leased, swapped, or otherwise encumbered, they must source it immediately at the current market price, whatever it takes. This creates a kind of invisible demand. It doesn't show up on retail charts. It doesn't trend on social media. But it matters enormously because it turns internal accounting promises into external buying pressure. And it tends to happen at the worst possible time, when prices are rising and liquidity is thin. Now, step back and look at the weekend as a whole. On one side, you have leveraged shorts facing margin stress with no ability to hedge until markets reopen. On another, you have dealers reluctant to sell because replacement risk is rising. On a third, you have institutions potentially converting paper exposure into physical claims. None of these forces guarantee a specific outcome, but together they tilt the balance. This is why Sunday night matters so much. When the Asian markets open, the first prints are not just prices, they're signals. A gap higher tells everyone that sellers were scarce at the old level. A sharp dip tells everyone that someone found liquidity and pushed back. The first hour sets the emotional tone for the week. But here is where discipline matters. Violent opens attract emotion. Emotion attracts leverage. Leverage attracts pain. Many people lose money not because they're wrong about the trend, but because they chase the most obvious move at the worst possible moment. That's why understanding the mechanics matters more than believing the story. The story is exciting. The mechanics are what decide who survives. In the next part, we're going to leave the risk room and follow the metal itself. We're going to look at how physical silver actually moves across regions, why price differentials matter, and how industrial demand interacts with financial markets. Not slogans, not panic, actual flows. Because in the end, paper contracts are promises, but metal has weight. And where that weight goes tells you more than any headline ever will. Up to this point, we've been talking about screens, spreadsheets, and psychology, numbers that flicker, positions that expand or collapse, risk managers staring at red cells on Excel. But silver is not just a number. It is not just a contract. It is not just a story people tell each other on financial television. Silver is a physical substance. It has weight. It has volume. It has to be dug out of the ground, refined, transported, insured, stored, and delivered. And when markets get stressed, the behavior of metal starts to diverge sharply from the behavior of paper. This is where things become interesting and uncomfortable for the system. Because while futures markets close on Friday, while risk desks run simulations, while traders argue on social media, the physical world does not stop. Mines keep producing, factories keep consuming, vaults keep opening and closing, ships keep moving. And right now, the physical flow of silver is telling a story that does not perfectly match the calm implied by a single quoted spot price. To understand what's happening, you have to stop thinking about silver as one global pool and start thinking about it as a regional market connected by price differences. Silver does not magically teleport to where it is needed. It moves because someone pays more for it somewhere else. That difference in price is called an arbitrage spread, and in stressed markets, spreads act like gravity. At the moment, the most important spread in the silver market is not between yesterday and today. It's between West and East. In Western financial centers, New York and London, silver is primarily traded as a financial instrument. Futures contracts, ETFs, unallocated accounts, derivatives. These markets are deep, liquid, and highly financialized. Most participants are not touching metal. They are trading exposure. The price discovered here has, for decades, been treated as the price of silver. In Asia, especially in China, silver behaves differently. It is still a financial asset, but it is also an industrial input. It goes directly into solar panels, electronics, batteries, and manufacturing supply chains. When demand there rises, it is not speculative in the same way, it is operational. Factories cannot substitute contracts for atoms. If the silver does not arrive, production stops. Now imagine a scenario where silver trades at $67 in New York, but the effective price buyers are willing to pay in Asia, after taxes, premiums, and logistics, is meaningfully higher. That difference might look small on paper, but in commodities, even a few dollars is enormous. It creates a powerful incentive. Send the metal east. Refiners, wholesalers, and large traders do not care about narratives. They care about margins. If shipping silver to Shanghai yields more profit than delivering it into a Western vault, that is exactly what will happen. Bars get allocated, pallets get loaded, insurance gets arranged. Metal leaves one system and enters another. This is not speculation. This is how commodity markets have always worked. Oil flows to where it is priced highest. Grain moves to where demand is strongest. Metals follow the same rule. And once a flow starts, it tends to reinforce itself. Because removing metal from one region tightens supply there, which pushes premiums up, which makes the other region even more attractive. This is what people mean when they talk about a physical vacuum. It doesn't mean the world has run out of silver. It means available silver in specific delivery locations is shrinking faster than it is being replenished. Now let's connect this to the structure of Western markets, because this is where misunderstanding becomes dangerous. Western exchanges rely on a layered inventory system. There is metal that exists, metal that is pledged, metal that is eligible, and metal that is registered for delivery. Most people outside the industry don't realize how thin the top layer really is. A large volume of contracts can rest on a relatively small amount of deliverable metal because, under normal conditions, most participants never ask for delivery. They roll contracts. They settle in cash. The system works because confidence works. But confidence is not static. It changes with price behavior. When silver is quiet, nobody rushes to take delivery. When silver starts moving fast, especially to multi-year or record levels, the incentive structure changes. Suddenly, holding a contract feels less safe than holding the thing itself. People who never cared about delivery before start thinking, what if I actually want the metal? Not everyone acts on that thought, but some do. And the system is not built for everyone to ask at once. This is where paper and physical can begin to diverge. If more participants decide to stand for delivery, the registered inventory gets drawn down. If metal is also flowing out of the region due to arbitrage, replenishment slows. The visible inventory number drops. That drop becomes a signal. The signal attracts attention. Attention attracts more delivery requests. This is not panic, it's reflexive behavior. At the same time, industrial buyers are operating on a completely different timeline. They don't care about weekly candles or technical patterns. They care about supply security. If you are a manufacturer that needs silver 6 months from now and you see price rising rapidly while inventories appear to tighten, your incentive is not to wait. It is to lock in supply. This is where off-market behavior becomes critical. In normal markets, industrial users hedge through futures. They buy contracts to stabilize costs. In stressed markets, futures become less attractive because they don't guarantee physical availability. You can win financially and still lose operationally if the metal doesn't show up. So some buyers go directly to miners, refiners, and long-term suppliers. They negotiate private deals. They prepay. They secure output before it ever reaches a public exchange. Every ounce secured this way is an ounce that never enters visible inventory. This creates a bifurcation that is extremely difficult to see if you only watch charts. The public market may appear liquid. Contracts trade back and forth. Volume looks healthy. But underneath, the physical pool that supports confidence is shrinking. And when confidence finally notices, the adjustment can be sudden. Now let's talk about premiums, because this is where everyday investors feel the divergence first. The spot price is a reference. It is not a guarantee. When volatility spikes and supply chains tighten, premiums expand. Dealers charge more not because they are greedy, but because their risk has increased. Replacement cost is uncertain. Delivery timelines stretch. Capital gets tied up longer. All of that gets priced in. When people say the spot price is broken, what they usually mean is this. The price you see on a screen no longer represents the price at which physical silver can be reliably obtained in size on demand without delay. That doesn't mean the screen price is fake. It means it is incomplete. Historically, this kind of divergence has appeared near important transitions in commodity markets, not always before a collapse, not always before a moonshot, but almost always before repricing, when the market tries to reconcile financial assumptions with physical reality. Now here's the discipline check. It is tempting to jump from these observations straight to dramatic conclusions. The vaults are empty. The exchange will default. Paper silver is finished. Those claims may make for exciting content, but they are rarely precise. Systems can stretch much further than people expect. They adapt. Rules change. Cash settlement options appear. Incentives get adjusted. What matters is not whether the system breaks tomorrow. What matters is whether the balance of power between paper and physical is shifting. And right now, multiple signals suggest that physical price is rising. Volatility is increasing. Premiums are expanding. Arbitrage flows are active. Industrial demand remains strong. None of these alone prove a shortage. Together, they create stress, and stress is what reveals structure. This brings us back to the weekend. While paper markets are closed, physical markets do not pause in the same way. Contracts may not trade, but logistics continue. Conversations happen. decisions get made, metal gets allocated. When markets reopen, the price has to reconcile all of that activity at once. That's why opens after stressed weekends can feel discontinuous, like the market skipped a step. But again, and this cannot be emphasized enough, volatility cuts both ways. A market under stress can surge. It can also snap back violently. False moves happen. Shakeouts are common. Weak hands get punished in both directions. Understanding physical flows does not give you certainty. It gives you context. It tells you why price might behave irrationally. It tells you why selling pressure might disappear at odd moments, or why bids might vanish suddenly if confidence wobbles. So where does this leave us? We have a market that closed at the highs on Friday. We have leveraged positions under pressure. We have dealers managing replacement risk. We have physical flows responding to regional price differences. We have industrial demand operating outside the futures complex. And we have a growing awareness that paper claims and physical metal are not the same thing when stress rises. That is not a prediction. It is a condition. In the next and final part, we're going to bring everything together and focus on execution. Not hype, not fear, but decision making. How do you approach a market like this on Monday morning? What signals matter in the first hour? How do you distinguish a real continuation from a bull trap? And how do you protect yourself from the single biggest enemy in volatile markets? Your own emotions? By the time you're watching this, the weekend is almost over. The silence is thinning. Somewhere, servers are warming up, liquidity providers are getting into position, and in a few hours, the first real vote on Friday's close will be cast, not by commentators, not by headlines, but by price itself. This is the most dangerous moment in any fast market, not because it determines the entire future, but because it determines who keeps their discipline and who loses it. Monday mornings after a high volatility Friday are not normal trading sessions. They are emotional traps. They are designed, by structure, not by intent, to separate patience from impulse. If you approach this open without a plan, the market will give you one, and you probably won't like it. So let me slow this down and get very clear about what matters and what doesn't. The first thing you need to understand is that the Sunday night open is not the real market. It feels important because it's the first print. It grabs attention because it can gap, but it is thin. Liquidity is low. Spreads are wide. A relatively small amount of capital can move price dramatically. That makes Sunday night a terrible place to make emotional decisions. Professionals watch it. They don't chase it. If silver opens higher on Sunday night, say above Friday, 67.14 close, that tells you something simple and powerful. Sellers were scarce at the old price. That's it. It does not tell you how far the move will go. It does not tell you that $70 is guaranteed. It does not tell you that you're late. It tells you that the market is repricing under pressure. That information is valuable, but only if you don't immediately react to it. This is the first rule of the battle plan. Observe the gap. Don't trade the gap. Most people lose money here. They wake up, see green, feel urgency, and confuse movement with opportunity. They buy because the price is rising, not because the setup is favorable. That's how strong hands transfer risk to weak hands. If you remember nothing else from this part, remember this. A gap buy is information, not an invitation. Now let's talk about the most likely behaviors, not predictions, behaviors. Scenario 1, gap and hold. Silver opens above 67.14 and does not immediately collapse. Price may chop, but it stays elevated. This suggests that buying pressure is persistent and sellers are cautious. In this scenario, professionals are not chasing either. They are watching for structure. They are looking to see whether the market builds support above the old level. That support matters more than the high print. Scenario 2, gap and fade. Silver opens higher, spikes, and then pulls back sharply in the first hours. This is extremely common. It does not mean the move is over. It often means early buyers took profits and weak hands panicked. The key question here is not, did it pull back? But where did it stop? This brings us to the single most important technical and psychological level of the week. The breakout zone around Friday. I am close. Markets have memory. When a level is broken decisively, price often returns to test it. This is not manipulation. It's verification. Think of it as the market asking, are you still there? If silver pulls back toward the 67 area and buyers step in, if price stabilizes and volume supports it, that is confirmation. That is strength behaving normally. If, on the other hand, price slices cleanly below that level and cannot reclaim it, that is information too. It tells you the breakout may have been premature, not fake forever, but early. This leads to the second rule of the battle plan. Do not confuse volatility with failure. A $2 or even $3 intraday swing in silver at these levels is not a breakdown. It's the cost of repricing. The people who get hurt are the ones who treat every pullback as a betrayal or every spike as proof of destiny. Now let's address the most emotionally charged number on everyone's screen. $70. Round numbers matter, not because of math, but because of psychology. $70 is not special because it changes supply or demand. It is special because it changes narratives. Below $70, skeptics can argue that silver is just volatile. Above $70, the argument becomes harder. That makes $70 a defensive zone. If price approaches $70 quickly, expect turbulence, expect selling pressure, expect attempts to stall the move. That does not mean the rally is over. It means the market is digesting attention. If you expect clean, straight-line movement through major psychological levels, you will be disappointed and probably stopped out. Here's where discipline beats excitement. If you are already holding silver, especially physical, your job is not to do anything dramatic. Your job is to avoid self-sabotage. Do not let short-term noise shake you out of a position you took for long-term reasons. Volatility is not a signal to act. It is a signal to think. If you are looking to add exposure, patience is your weapon. Let the market show you where it wants to build support. Let the emotional traders exhaust themselves. Buying strength after confirmation is very different from chasing a vertical candle out of fear. This brings us to the downside scenario, the one nobody wants to think about, but everyone needs to respect. There is always a possibility that the market uses thin liquidity to stage a sharp drop. This can happen for many reasons: profit-taking, macro headlines, positioning shifts, or simply the need to reset sentiment. If silver were to fall decisively below the breakout zone, especially below levels where buyers previously defended, it would signal that more consolidation is needed. Here's the critical distinction. A pullback does not invalidate a thesis. Losing structure does. If the market pulls back but holds key levels, that is healthy. If it breaks and stays broken, that's caution. Either way, panic is never the correct response. Panic is how the market taxes impatience. Now let's talk about leverage, because this is where most damage happens. High volatility environments are brutal to leverage positions. Options decay faster. Margins tighten. Small moves become large losses. Many people write us about direction and still lose money because their position cannot survive the path. This is why professionals constantly repeat an unglamorous truth. Position sizing matters more than predictions. If you're leveraged and this market snaps back even briefly, you may be forced out at the worst possible moment. Physical holders do not face margin calls. Unleveraged positions have time. Time is the most underappreciated edge in volatile markets. Now zoom out one last time and ask the only question that actually matters. Has the character of the market changed? A close at the highs suggests it has. Rising volatility suggests it has. Tightening physical conditions suggest it has. That does not mean the path forward will be smooth. It means the old assumptions, easy fades, predictable Friday sell-offs, endless patience from sellers, are being challenged. When assumptions break, markets reprice. So here is the full Monday checklist. Simple and unemotional. Watch the Sunday night open, but don't trade it. Observe whether price holds above the Friday close after volatility. Look for confirmation, not excitement. Expect turbulence near round numbers. Respect downside risk without panicking. Avoid leverage if you value sleep. If you do those things, you are already ahead of most participants. The banks may be stressed, dealers may be cautious. The metal may be moving quietly where cameras don't look. But your job is not to dramatize the moment. Your job is to survive it, and if you're prepared to benefit from it over time. Markets reward those who stay rational while others react. Friday's close was not the destination, it was a signal. What happens next will not be decided by one candle, one gap, or one headline. It will be decided by behavior, yours included. Stay calm, stay patient, and let the market show its hand before you play yours. If you want to understand why most people lose money in markets like this, you don't need a chart. You need a mirror. Because by the time silver closes a Friday at the highs, gaps on a Sunday night, and dominates every conversation by Monday morning, the biggest risk is no longer the banks, the shorts, the dealers, or the system. The biggest risk is you, your reactions, your expectations, and the stories your mind starts telling itself. Markets do not transfer wealth randomly. They transfer wealth from the impatient to the patient, from the emotional to the disciplined, from the reactive to the prepared. In moments like this, high volatility, strong narratives, intense conviction, are where that transfer accelerates. Let's talk about the first psychological trap: urgency. Urgency feels productive, it feels intelligent. Your brain says, something is happening, I must act. You see price moving fast, you see people online celebrating. You see headlines screaming, short squeeze, supply gone, banks trapped. Your body responds before your mind does. Heart rate up, fingers twitching. You don't want to be the person who knew and didn't act. This is not intuition, this is adrenaline. Urgency compresses time. It makes you forget that markets existed before this week and will exist after it. It makes you believe that this candle, this hour, this price is your only chance. And that belief is deadly because it pushes you to act without confirmation. Professional traders are not immune to urgency. but they train themselves to recognize it as a warning signal, not a call to action. When urgency spikes, they slow down. Retail traders usually do the opposite. They speed up. The second trap is confirmation bias. Once you believe the story, banks panicking, silver disappearing, price going to $100, you start filtering information. Every bullish data point feels important. Every bearish signal feels irrelevant or manipulated. This is how people end up holding positions far larger than they intended, with far more risk than they realize. Confirmation bias is especially powerful in markets tied to real-world frustration. Silver attracts people who already distrust the system. That doesn't make them wrong, but it does make them vulnerable to narratives that feel emotionally satisfying. When price action aligns with that worldview, belief hardens into certainty. Certainty is dangerous. Markets don't punish belief. They punish rigidity. When you stop updating your view based on new information, you stop trading. You start defending an identity. The third trap is binary thinking. People love clean outcomes. Either the banks lose control or the move is fake. Either silver goes vertical or it crashes. Either you're early or you're an idiot. Reality is rarely that simple. Most major moves are messy. They surge, stall, pull back, fake out, retest, and only then resolve. The people who survive are not the ones who predicted the end result perfectly. They are the ones who managed the path. Binary thinkers get shaken out because every pullback feels like betrayal and every rally feels like validation. They overreact in both directions. They buy tops, they sell bottoms, and then they blame manipulation for what is actually emotional mismanagement. Now let's talk about the most expensive trap of all, leverage. Leverage feels smart when volatility expands. You tell yourself you're maximizing opportunity. But leverage does one thing extremely well. It removes your ability to be wrong temporarily. And in markets like silver, being wrong temporarily is almost guaranteed. Even in the strongest bull markets, price does not move in straight lines. It pauses, it shakes, it hunts stops. It does things that feel irrational but are structurally normal. Leverage turns those normal moves into existential threats. This is why the market seems rigged to so many people. Not because price is manipulated every second, but because most participants put themselves into positions that cannot survive normal behavior. When you cannot survive noise, noise becomes fatal. Physical holders don't feel this pressure. They don't get margin calls. They don't get liquidated at the lows of a shakeout. They don't have to make decisions every hour. Time is on their side. That doesn't mean physical is perfect, but it does mean it is psychologically aligned with long-term theses. Paper traders, especially leveraged ones, live in a different reality. Every tick matters. Every headline matters. Every rumor feels existential. And that constant stress leads to bad decisions. Here is the uncomfortable truth. Most losses happen, not because people are wrong, but because they are right too early with the wrong structure. Now let's address the fear on the other side, the fear of missing out. FOMO is not greed. It's fear dressed as ambition. It tells you that everyone else is ahead of you, that the window is closing, that if you don't act now, you'll be left behind watching others win. Markets exploit this fear relentlessly. Strong moves create social proof. Social proof creates crowd behavior. Crowd behavior creates unstable price action. And unstable price action is where professionals harvest liquidity from emotional participants. If you feel late, ask yourself this. Late relative to what time frame? Late relative to which thesis? If your thesis is a multi-year repricing of silver driven by industrial demand and monetary stress, then a $2 or $3 move is irrelevant. If your thesis is a 2-day momentum trade, then yes, you might be late. The mistake is mixing time frames without realizing it. Clarity of intent is everything. Now let S flip the perspective and talk about what winning behavior actually looks like in moments like this. Winning behavior is boring. It does not feel heroic. It does not come with adrenaline spikes or dramatic social media posts. It looks like waiting when others rush. It looks like smaller position sizes than your ego wants. It looks like accepting that you do not need to capture every dollar of a move to succeed. Winning behavior asks better questions. Is this move being confirmed by structure or just emotion? Am I acting on information or reacting to excitement? Can my position survive being wrong for a week, a month? If the answer to the last question is no, then the position is not aligned with reality, no matter how compelling the story sounds. There's also a trap that hits people who have already made money: overconfidence. When silver moves in your favor, your brain quietly rewrites history. You forget the doubt you felt when you entered. You forget the luck involved. You start believing your read of the market is sharper than it is. That's when people add size at the wrong moment, loosen risk controls, and give back gains. Markets are especially cruel to overconfidence after validation. They don't correct immediately. They let it build, and then they snap. This is why professional traders often say, the market is most dangerous when you feel smartest. So what does discipline look like right now? It looks like accepting uncertainty. It looks like letting the market prove itself over time. It looks like focusing on levels, behavior, and structure, not predictions. It looks like understanding that volatility is not opportunity by default. Volatility is only opportunity if you are positioned to survive it. And perhaps most importantly, discipline looks like humility. The humility to say, I don't know exactly what will happen next, but I know how I will respond. That mindset is rare, and it is powerful. Because whether silver goes higher this week, chops sideways, or pulls back violently, the real separation is already happening. Not on the chart, but in the minds of participants. Some will chase, some will panic, some will freeze, and some will wait. In the final part, we're going to step back one last time and answer the question that actually matters long term. What does this moment mean in the larger cycle? Not tomorrow, not next week. But in the context of how markets reprice assets when old assumptions stop working. When markets reach moments like this, people naturally ask the wrong question. They ask, what happens next? Will silver gap higher? Will it pull back? Will it hit $70 this week or stall? Those questions feel important, but they are short-lived. They satisfy curiosity, not understanding. The better question, the one that actually matters, is this: what kind of phase has the market entered? Because markets don't move randomly, they move in phases. And when a phase changes, the rules that worked before quietly stop working. People don't realize it at first. They keep using the same playbook, expecting the same outcomes. That's when frustration sets in. That's when losses pile up. And that's when repricing begins. Repricing is not a single event. It's a process. Most assets spend years oscillating inside a range where expectations are stable. Buyers and sellers roughly agree on value. Volatility exists, but it is familiar. The market feels understandable. In those phases, mean reversion works. Selling strength and buying weakness feels smart because it usually is. Then something shifts. Sometimes it's demand, sometimes it's supply, sometimes it's policy, sometimes it's structure. Often it's a combination of all of them. The shift does not announce itself loudly. At first, it looks like noise, a breakout that fails, a rally that surprises people, a pullback that doesn't go as deep as expected. Over time, those anomalies accumulate. That's where silver appears to be now. Not at the end of a move, but at the end of old assumptions. For years, silver has been treated as a market that rallies only to disappoint, a market where enthusiasm gets punished, a market where paper supply always appears when price rises. That belief shaped behavior. It shaped positioning. It shaped how traders, dealers, and investors responded to strength. But beliefs are only stable until they aren't. A close at the highs after repeated attempts to push price lower is not magic. It's not destiny. It's a signal that the balance of pressure has changed. Sellers who used to feel confident are now cautious. Buyers who used to wait are now more urgent. That doesn't guarantee higher prices tomorrow. But it does suggest that the market is negotiating a new equilibrium. This is what repricing looks like in real time. It is messy. It is uncomfortable. It feels irrational to people anchored to the old range. It feels obvious to people who arrive late. And it feels emotionally exhausting to everyone involved. One of the biggest mistakes people make during repricing phases is expecting clarity too early. They want confirmation immediately. They want the market to behave cleanly so they can feel justified. But repricing rarely offers that luxury. It advances through tension. You see this tension everywhere right now. In paper markets, where leverage amplifies, moves, and forces quick decisions. In physical markets, where replacement risk makes sellers defensive. In industrial demand, where procurement happens quietly and outside the spotlight. In investor psychology, where fear and greed collide at higher speeds. All of these pressures interact. None of them alone define the outcome. Together, they change the trajectory. Another mistake people make is assuming repricing means straight line appreciation. It doesn't. In fact, repricing often comes with more volatility, not less. Prices overshoot. They snap back. They test conviction repeatedly. This is not a bug of the system. It is the mechanism by which weak positioning is cleared and stronger hands take control. That's why these phases feel unfair. People who were right too early get punished. People who chase get punished. People who over-leverage get punished. And people who confuse narrative certainty with risk management get punished. What survives is not intelligence. It's structure. Structure means aligning your position with your thesis and your time frame. If your thesis is long-term, industrial demand, constrained supply growth, structural stress, then short-term volatility is not the enemy. It's the toll. If your position cannot survive that toll, then it doesn't matter how compelling your story is. This is where silver exposes people. Silver has always been a truth teller. It reveals how participants handle uncertainty. It reveals who needs constant reassurance and who can sit through discomfort. It reveals who is trading price and who is trading identity. Markets don't care about identities. They don't care if you believe the system is broken or fair. They don't care if you distrust banks or defend them. They don't care if you think silver should be higher or lower. They care about flow, who needs to buy, who needs to sell, and who can wait. Right now, flow is under negotiation. That negotiation will not be resolved in a single candle or a single week. It will resolve through behavior over time, through whether pullbacks are bought or sold, through whether volatility is absorbed or rejected, through whether physical constraints tighten or loosen, through whether confidence in paper exposure holds or erodes. The market will tell us, but only if we listen to behavior, not emotion. This brings us to the most important takeaway of this entire series. The opportunity here is not about predicting a number. It is about recognizing a transition. Transitions are rare. They don't happen every year. They don't happen every cycle. And they are often invisible while they are happening. Most people only understand them in hindsight, when the price is already far away from where it started. Being early in a transition does not mean being aggressive. It means being patient when others are reactive. It means respecting volatility without fearing it. It means accepting uncertainty without freezing. And it means avoiding the temptation to turn a market thesis into a personal crusade. Because once you attach your ego to an outcome, the market owns you. The people who do best through repricing phases are not the loudest. They are not the most confident. They are the most adaptable. They update their views. They size appropriately. They let the market confirm before they commit further. They survive long enough to benefit. If silver continues to reprice higher over the coming months or years, it will not reward everyone who believed in it. It will reward those who stayed rational while believing. And if it stalls, consolidates, or even pulls back sharply before continuing, it will punish those who mistook excitement for inevitability. So, as this chapter closes, here is the calm truth beneath all the noise. You do not need to be perfect. You do not need to catch the exact low or sell the exact high. You do not need to outsmart the market. You need to outlast your own impulses. Friday's close was a signal. The weekend was a stress test. Monday and beyond are a process. Whether this moment becomes a footnote or a turning point will be decided not by headlines, but by how participants respond when the excitement fades and the work begins. That is how repricing happens. Quietly at first, violently in the middle, and obviously at the end, when it's too late to pretend it was obvious all along. Stay disciplined, stay curious, and remember, the market does not reward conviction alone. It rewards conviction that can survive reality. That's the real edge.